Hi there, welcome to Kneppy Invest. In today's video, I'm going to be discussing a company I have a fairly large love-hate relationship with, and that is Bigtincan, either the best named company on the ASX or one of the worst named companies. I really haven't decided that. I have been in and out of this company ever since they listed back in, I think it was something like May or March 2017. And I was entranced by what this company does. In terms of them being a SaaS company, sales enablement, that sort of thing. I thought it had a lot of growth potential, even though there are big players in this area. Salesforce comes to mind, but I thought they did have that potential growth, and I did like the software SaaS area. Now, my thoughts on that area have changed subtly over the past year, and I want to see these companies show me that they can achieve scale. And when it comes to scale, and Bigtincan, I haven't really seen that yet. So before we get into looking at the December quarter, and it was an operational cash flow positive quarter, which is rare for this company. Bigtincan, on occasion, will produce an operational cash flow positive quarter. But it seems like whenever they do that, they decide to increase their spending, so they become operational cash flow negative in the next few quarters. So that's one of the reasons I do have a love-hate relationship with this company. I would love to be a shareholder of this company for the long term, but at this point in time, they haven't shown me scale, and I want to see them achieve scale, because that's one of the reasons why I was entranced by this sector, because I believe that they're very capital light and they would be able to achieve scale really easily, and that means increasing your revenue without much of an increase in costs. But most of these companies have not shown me or the market that. And that's why there is a big weakness in this area. And we have seen share prices fall quite a bit over the past year. So before we have a look at the December quarter, Benny's 4C, just a few facts in regards to Bigtincan. I've already mentioned that Bigtincan is a sales enablement company, and they call it an intelligent enablement platform. But this is all about having sales team and improving the performance of sales team and improving your relationships with the buyer. So this is a graphic I have seen a lot in Bigtincan's presentations. So learning, content, and engagement between seller and buyer, and that way you improve efficiency, decrease costs, that sort of thing, for those who are using this intelligent enablement platform. Bigtincan was founded in 2011. This is according to the website. In fact, on some other websites, I have seen that Bigtincan was incorporated in 2010, but I'll just stick to what the Bigtincan website says about themselves. They listed on the ASX 24th of March 2017. I do remember that listing because I took a position in the Bigtincan not long after they did list, and I went against some of my rules because I don't want to, or usually don't want to, invest in a company that has just recently listed on the ASX. But I did think this company had a good future, and I was more into long-term buying at that point in time. Current CEO is David Keane. He has a 4.1% holding in the company. And the largest shareholder in Bigtincan is a fund manager I don't know much about. It seems like they are an international fund manager, maybe located in United States, maybe Colorado, if I remember correctly, maybe Utah, that sort of area, but they have a 13.7% holding. The market cap at 88 cents is 480 million. And we have seen the market cap of this company significantly higher because the share price has been under pressure the past few months. The ticker code of the company is BTH. Now, one of the problems I do have with many companies like this is these sort of companies can be highly dilutive to shareholders. And we have seen the shares on issue for Bigtincan increase from 176 million to 547 million. That's almost a quadrupling in the shares on issue. One of the reasons they have increased shares on issue is because of acquisitions, but the other reason is they have been operational cash flow positive and they need more money for working capital. Now let's have a look at the Bigtincan financial history, and this is looking at half-year numbers, not quarterly numbers. This is half-year numbers since the company listed on the ASX. And the main thing I'm looking at here, and we are focusing on revenue, profit. Revenue is in the blue, profits in the black, and cash flow from operations is in the green. And the first thing I always look at when I am researching a company is to look at the growth in revenue through time. Don't want to see revenue going nowhere or going backwards, because the only way you can grow income, which is profit or cash flow, without increasing revenue is by decreasing costs. And there's only so far you can decrease costs without seriously affecting the business. Anyway, the main thing here is revenue has been growing through time at a fairly consistent pace year on year. In fact, there hasn't been one half year where revenue has gone backwards. And the company has increased the revenue from $5 million to $25 million. So that's a massive tick in my book. That is something I am definitely looking for in an investable company. Now, when it comes to income or profit and cash flow from operations, that's where we do have a problem for this company. We don't see any growth. In fact, the last few half years have been the worst half years in terms of profitability and cash flow for this company. We actually have seen profitability down as low as around minus 8 million, 9 million in 2 of the last 3 half years. And 2 half years ago, they had their worst operational cash flow, minus $9 million. There have been operational cash flow on occasion. We did see there was one half year, they were operational cash flow positive by $5 million, but they were unprofitable that half year by minus 8. So I just want to see some scale in this business. And when you look at this graph, the first thing you have to understand, when you see revenue growing, but profitability and cash flow not growing with it, in fact going backwards, that is telling us the company has no scale right now. Before we have a look at the most recent Appendix 4C for Bigtincan, let's just go back 1 year ago to see how this company has progressed over the past year. Now, receipts for customers 1 year ago, 10.5 million. And because this company has a lot of costs, particularly staff costs, that's the one thing you do notice about the cost for this company. They do employ lots and lots of people. And in this particular quarter, they spent $9 million on staff costs, $1.9 million in administration, and only $612,000 on advertising and marketing, and no money on product manufacturing and operating costs. Because they spent so much money on staff costs, the company was operational cash flow negative by $1.1 million. Now, cash on hand has never been a problem for Bigtincan because they always raise capital. So you always see an influx in money due to capital raisings. And in this particular quarter, they made an acquisition, $27.2 million. They also spent a little bit of money on intellectual property, $1 million in this quarter. But because of that acquisition, cash on hand actually fell from $63 million to $33.4. So now let's have a look at the most recent quarter that was operational cash flow positive. Now, Bigtincan did make a major acquisition. How long ago was that? Maybe 6 months ago. Brainshark or something like that. The market actually got really excited. You'll be able to see that when we look at the chart. When they announced this acquisition, the share price really jumped up, almost reached an all-time high. And when I did read about this acquisition, I thought it was a very astute acquisition. And they got it fairly cheap, in my opinion, and it fit into this company right well. And I think that's why the market got excited. I'm not sure how much of the increasing receipts is attributable to that acquisition, but we did have seen a significant increase in receipts up to $26.3 million. And you notice here staff costs have increased significantly as well, up to $20.2 million. But over the past year, costs haven't increased quite at the same rate as receipts. So the company has gone from slightly operational cash flow negative by $1 million to operational cash flow positive by $1 million. So receipts up by $16 million, advertising and marketing up by $600,000, that's doubled. Staff costs up by $11.1 million, that's doubled. And administration costs up by $1.9 million, that's also doubled. But the cash receipts have more than doubled. And that's why the company is operational cash flow positive now. Now this is operational cash flow, not net cash flow. They spent $4.9 million on intellectual property. So Bigtincan is not free cash flow positive. That's usually the next step I take. I don't usually mention that in videos because a lot of companies I do feature in these Appendix 4Cs don't spend a lot of money in investing and financing activities. And so the main area you have to look at is operating activities. That's not true with companies like Bigtincan, who might spend $5 million on intellectual property and might be acquiring companies. So because they were bleeding cash in investing and financing activities where intellectual property does fit in. Cash on hand actually did not increase during the year or during the quarter, even though they were operational cash flow positive. In fact, it fell by almost $6 million and finished the quarter at 49.9. Now onto some commentary. And this was an interesting comment I did see. So they mentioned 198% improvement in net cash from operating activities year on year, demonstrating sound cash management and operational efficiency. So from that comment, we know that the management is focused on costs. We know they might be focusing on cash flow from operations as well. This is the first sign that maybe there is a switch in what the management is focusing on. So instead of focusing just or solely on increasing receipts or revenue or annual recurring revenue, they have their mind on becoming operational cash flow positive, on maintaining control on costs, and becoming profitable in the short to medium term. And maybe the reason they have maybe changed their tune slightly is because this overall negative sentiment in these sort of companies. One thing I always look at for SaaS companies, these software sort of companies, is how their annualized recurring revenue is traveling, going up, going down, going sideways. Sometimes if you do see a decrease in annual recurring revenue, the company share price will be affected by a lot. And we saw that with Damstra. Damstra's share price fell off a cliff because their annualized recurring revenue actually did drop because they lost one big client, American Airlines, if I remember correctly. But this video is not about Damstra, it's about Bigtincan. And this company has never had a problem increasing annualized recurring revenue. We have the last 3 years, going back to financial year 2019, 23.4 million, financial year 20, 35.8, financial year 21, 53.1, and they expect annualized recurring revenue to be about $119 million in financial year 22. So I'm assuming that's at the end of the financial year, so that's June 30, 2022. There were some concerns that from the most recent update, the end of the half year, to the end of the financial year, that annualized recurring revenue didn't grow that much, or expectations weren't they won't grow that much. But one of the reasons we have seen a significant growth in annualized recurring revenue over the past year is because of the acquisition this company made. Again, I think that was Brainshark, and that really pumped up the annualized recurring revenue. And I thought it would pump up the share price as well, because one of the things I do, this is a really rough estimate I've been doing over the past 10 years, is I just multiply annual recurring revenue by 10 to get a rough estimate about the possibilities of where the share price and the valuation of the company can be. And that's totally ignoring the growth in analyzed recurring revenue and the growth in cost. And if you do that, so it's a very rough estimate, if you do that with Bigtincan, you get a valuation of $1.2 billion, and the share price or valuation of the company is nowhere near that. If you look at the past 3 years, that sort of multiplying factor has worked out fairly well for this company. Not always, and it doesn't work well for all companies, and it's a very rough estimate. So I just want to say that again. It's a very rough estimate I have used, and then I take into account the growth in annual recurring revenue, also the growth in costs. Talking about growth in costs, I've included this, or the growth in costs, in the receipts history for the company. And this is probably one of the only companies I've done this for, and I've shown you. Most of the times I do a video and show receipts history, all I'm looking at is growth in receipts through time. That is the first thing I am looking for. And really, Bigtincan don't have a problem in that regard. We have seen receipts grow through time. On occasion, it can be quite lumpy, and we saw back in September 2020, receipts fell from over a three-quarter period. Receipts fell from 15 million to less than 5 million, but then they jumped up again. So don't look at one receipts quarter in isolation. You need to look at the trend. And receipts have grown from about 3 million all the way up to 25.2 million over the past almost 5 years since this company has been on the ASX. But I've also included the costs, and this is the 3 major costs this company has just by looking at Appendix 4C, and it's the orange line that is almost mirroring the growth in receipts. And most quarters, this company is operational cash flow positive. On occasion, they will be operational cash flow. Did I say that right? So this company on most quarters is operational cash flow negative, but on occasion, the company is operational cash flow positive. In fact, we saw that September quarter 2017. In fact, there was 3 quarters there, they were almost operational cash flow positive. We saw it again in the March quarter 2020, where this company was highly operational cash flow positive, and again in the most recent quarter. But every single time this company does achieve or become operational cash flow positive in the one quarter, they increase their costs, and we also might see the cash receipts go down in the next few quarters. So the thing here, and the concern for me is, with costs mirroring the growth in the receipts, the company is not showing scale, and I want to see that scale there. I want to see this company grow their receipts at a greater rate than their costs. And if they do that, the company will become operational cash flow positive on a consistent basis, become profitable. And if they become operational cash flow positive on a consistent basis, they can grow their company through their operations. They won't have to do any more capital raisings unless they do a major acquisition. I did calculate the growth rate in receipts and costs since March 2017. Receipts have grown 11.5% per quarter, and costs have grown at 10.6% per quarter. So there is a little bit of a difference there, but that's just could be just a little bit of variance because of the most recent quarter. I think if you calculate this in the last quarter, the September quarter, costs might be growing at a greater rate than receipts. But again, the growth in receipts and the growth in costs are almost mirroring each other, and I want to see some scale. And when we see scale, again, receipts will be growing at a greater rate than costs. Now onto the data chart for Bigtincan. This is the 1 year daily chart. Usually I do put in the moving averages, but I've decided just to eliminate from this graph in particular because it just makes it a little bit too messy. I have 2 major lines here. The first line is a support level at about 78 cents. The reason I call that support level is back in March and May of last year, the share price reached 78 cents, and then we saw the share price rebound. So that happened twice. You could almost call that a double bottom, which is a fairly bullish signal. And then from the time the share price reached that 78 cents in May, we saw a lot of positive momentum in this company. Share price rose from 78 cents to a high of about $1.53 over about a 4 to 5 month period. And you can see that massive gap in the share price in August of last year. That's around the time they made that acquisition of Brainshark. The market absolutely loved that acquisition, just like I did. I thought it was a very astute acquisition. I think I've already mentioned that. And another thing to mention here is they did a capital raising in regards to the acquisition. The price of that capital raising was $1.10. So shareholders could buy Bigtincan shares at $1.10 through that capital raising, and with the share price at $1.50, there was a lot of shareholders who thought they could take part in the capital raising, sell their shares at $1.50, and that would make a massive premium. Unfortunately, the share price did not hold on to that $1.50, and ever since that high we saw at $1.50, the share price has been in a well-defined downtrend, which is represented by that sloping black line. And anytime a share price gets to that downtrend, the share price pulls back. So it has touched that line about 3 times. And most recently, 3 trading days from when I'm doing this video. So that would be towards the end of last week, which would have been about the 10th of February. Now, during the overall negative sentiment in the market, share price almost reached that support level at 78 cents. In fact, the share price went below 80 cents for a brief period of time. So at this point in time, I'm keeping an eye on that the share price in Bigtincan. If it falls through the support level, that would be fairly bearish. But if it goes above the downtrend, that could be a signal that the downtrend has come to a completion. And there is potential, because those 2 lines, the support line and the downtrend, are moving towards each other, there is a potential that we could see a breakout in the share price to the upside with that support level being maintained. So that would be a bullish move. You'd also look out for volume. If you see a lot of volume coming in, if the share price moves towards 78 cents and that downtrend moves towards that level as well, that would be a fairly bullish signal as well. The bearish signal would be if the share price falls below that support level. That would be a really bearish signal. And if the downtrend maintains, we just don't know how low the share price could go from there. That's all I have for this December quarter Appendix 4C video for Bigtincan. They were operational cash flow positive for this quarter. That's a good start. And the fact that their commentary did mention in a little line that this shows strength in the company in terms of cash management, that sort of thing. Does make me think that maybe the management is now trying to focus not only on growing revenue, annualized recurring revenue, but also focused on cash or cost management and operational efficiency. So really interested to see how this company performs in the current quarter, maybe even the next quarter, which would be the June quarter, the last quarter of the financial year. If you have any questions about Bigtincan, just leave them in the comment section of this video. Otherwise, that's all I have. And the last thing I always should mention is I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.